Welcome and thank you for joining us for the lessons learned from the 2021 Long-Term Perspectives publication and how these lessons can be applied to the investment portfolios of clients. My name is Gontse Tsatsi and I will be your host. 2020 started in an unprecedented manner as the pandemic wreaked havoc on societies, economies, health systems, and the markets. The 8th edition of this publication may come at a time of extraordinary uncertainty, but its premise and the lessons remain unchanged. Today, we will unpack the drivers behind the returns of the different asset classes and highlight the importance of diversification and time in the market. Market research covering a period of 91 years shapes our perspective for a long-term outlook, thereby looking beyond the shorter-term market fluctuations. I'm joined by Portfolio Manager Graham Tucker, who will unpack the drivers from a historic perspective, and MacroSolutions Boutique Head, Siboniso Nxumalo, who will do the same from a forward-looking perspective. Before I hand over to Graham, please note the following. Each of their presentations will be around 20 minutes long, leaving 10 minutes towards the end to answer your questions. You are encouraged to ask questions at any stage, and you can do so using the chat functionality on the right-hand side of your screen. We have 2 downloads available today. For the publication, you can click on the top right-hand image, and that will allow you to download the publication. And for the presentation, you can click on the link below Files Download, which is on the bottom right of your screen. Graham, over to you.
Thanks, Gontse. As Gontse mentioned, part of the power of this document, this work that we do every year, it allows us to look back over a long period of time to see what lessons we can take from history. Because I think when we're caught up in the middle of the storm, it's very difficult to make rational decisions. And so having these lessons, being able to look back on how one should have behaved historically, and then implementing or trying your best to implement those lessons at that point in time when you're in the middle of that storm, for us, that's the real power of this work. So as you mentioned, 90 plus years worth of data, and what we're going to take you through are some of the lessons that we've learned and how those lessons applied in 2020. So we're going to start off by looking back, and then from there, I'll hand over to Siboniso, and he'll take us through his thoughts in terms of how to take these lessons going forward, and also the impact around or the impact of COVID, what that means for businesses, for markets, etc. So let's look back at what we could have learned or what lessons we could have applied in 2020. So the first one is really around the lesson that we call cash is trash. Now, for the first few months of 2020, cash was an incredibly valuable asset, and we'll see that in the next slide. But the issue is that in response to the crisis, central banks cut rates extremely aggressively. So in South Africa alone, we had nearly 300 basis points of rate cuts. In the US, it was roughly 1.5. They almost cut to zero again. In the UK, again, almost cutting to zero. Turkey, I think, was nearly 400 basis points worth of rate cuts. It was a global story because as policymakers realized that they needed to support their economies in the face of this crisis. So while it helped initially, it was a very expensive asset to own through the rest of the year as equity markets recovered. And that really leads on to the second lesson that could be applied during 2020, and that was around active asset allocation. So if you stayed in cash the whole time through the year, you may have felt very good, and then you probably felt some pain as markets recovered, but you were starting to earn lower and lower cash yields from that investment. And then the third lesson is really around the high cost of missing out. And that one really talks to that being in the middle of the storm. Because what we see looking back at that history is that often we make the worst decisions at the worst possible times. So when markets are falling or almost collapsing, it creates a fight or flight response. And if we leave markets at that point, if we disinvest at that point, what history shows us is that you actually miss some of the best days going forward. So you almost get out too late. You almost capitulate as investors, and then we miss the good days. And that actually has a material impact on the growth or the return that we earn on our investments over the long term. So let's just go through some of these in a little bit more detail. So as I said, this is just looking at the performance of cash and the South African equity market from the beginning of 2020 through to the bottom of the market towards the end of March 2020. And this is indexed to 100, so you can see the relative performance of the two. So what you see in those first 3 months is cash was an extremely valuable asset. It gave you protection from the collapse in markets. But more importantly, if you had cash, it actually meant you had ammunition to buy markets at those lower levels. So when we talk about cash as trash, obviously it has value in some short-term instances, such as we saw in February and March of last year. But longer term, it's a very expensive asset to hold. And sorry, just in terms of this correction that we saw in markets, looking back at the history of corrections looking at the data that we have, this was one of the fastest, if not the fastest, fall in markets from peak to trough. It happened in a matter of 4 or 5 weeks. And then also recovered just as quickly as it did during the global financial crisis. So this, I know people often throw around the word unprecedented, but in many ways, this was an unprecedented sell-off in markets. And actually, if we look forward, if we roll that graph, apologies for that, if we roll that graph forward to current levels, it actually turns out that was a fantastic buying opportunity. A time to really allocate from cash into growth assets. And this is something that we did on behalf of our clients quite successfully. Now, the reality with investing is you're never going to get the bottom of the market. So you're never going to get that March 23rd bottom. But even if you bought equities, say a month after the bottom or a month before the bottom, you've still made fantastic returns because you've bought equities at much lower valuations. So price was very attractive, but also you had policymakers stepping in because things were starting to look dire. And so policymakers stepped in by, as I mentioned earlier, cutting rates aggressively, implementing fiscal policy, again, on an unprecedented scale. And Siboniso will touch on that in a few slides. And it was really an opportune time, I think, to, if you had cash on the sidelines, to put it to work. So what we see here is while equities fell nearly 37% in the first 3 months of the year, from that point onwards, you've earned a return of almost 70% against cash that has given you just under 5% during that time period. So really, there was a holding cash for the last 12 months has actually been a very expensive decision. If we step forward to the third lesson, which is around the high cost of missing out. So what you see is markets falling sharply several days in a row. So we're looking here at the daily return of the capped SWIX. Now, typically, we're not going to look at daily returns because it's far too short term. But I think for this lesson, it's incredibly important because those days when markets were down 6, 7, 8%, the fact that we were getting so many of those days in such a short period of time, I think can create a lot of uncertainty in the minds of investors. And so I think the natural response there is to say, well, I can't handle this anymore. If these markets are just falling in a heap, I've got to get out of here. But what you see in those days after those big drops is you still get one or two decent down days. So you have a -6, a -5. As you roll through the first half of the year, you get the occasional -4 and -2. But actually, you've missed out on some really strong days after the markets have turned. And again, you don't know when markets are going to turn. So you could have bought after the first big down or the third big down. It does. If you bought any time in that anywhere in that period, you've managed to capture those very strong positive returns that we saw just 3 months down the line. And as we saw in the previous graph, that continued and is still at play today. So I think looking back on 2020, the lessons that we put forward every year, I think proved invaluable. And so just to recap those, I think number one is cash is an expensive asset to hold long term, and you need to invest that. And 2020 was a fantastic time to buy assets at cheaper prices. That meant active asset allocation. You had to have an active asset allocation mindset, so allocating money from cash to equity markets. And that's not the only one. There are obviously other markets that rebounded quite nicely, but that's the big decision that needed to be made. And then the third one is around fighting your instincts, and because often following your instincts can mean that you miss out on some of those really strong days, and that can have a material impact on your wealth and your ability to generate wealth over time. And I think with that, I'm going to hand over to Siboniso to take us through the forward-looking picture.
Thank you very much, Graham. Good morning, everybody. My name is Siboniso Nxumalo, and I'm a portfolio manager and boutique head at MacroSolutions at the Old Mutual Investment Group. So we've spoken, Graham has taken us about looking backwards. Let's understand what has happened last year, being a year full of tumultuous activity and actually quite full of a lot of things that actually helped us reflect on our timeless lessons in writing this annual publication called Long-Term Perspectives. Where I want to take us now, I want us to look forward, because 2020 came, now we're in 2021, and we've got to apply these lessons going forward. So what are we seeing? What is the impact of COVID? What are the things that we are starting to think through and work through in building client portfolios looking forward? And I think my starting point is a strange title called warning labels. If you go to your medicine cabinet and you look at your medicine, and obviously you only take medicine if you are ill in some way or another. But in your medicine, there'll be instructions, there'll be labels with instructions of the correct dosage to take, when to take the dosage, do you take the dosage with food or not, etc. But below that, if you look at every medicine that is issued, there's something called a warning label that talks about, hey, wait a minute, if you take more of this dosage than is recommended, there will be consequences that you actually do not want. There'd be adverse or negative consequences on your body as a person. And so warning labels are very important. 2020, the year started off in an amazing cheer. Actually, there were record markets consistently for quite a while. But actually, all of a sudden, everyone heard about this virus from Wuhan, this with flu-like symptoms. Suddenly, it led to the second largest economy in the world, which is China, shutting down what is a huge province. And suddenly, the world effectively actually also got sick. And so therefore, when you shut down the world gets sick, global economies come to a sudden stop, it triggers a recession and it triggers negative economic consequences. Now, what do governments do? Governments then come in and they stimulate. And the governments come in and they stimulate, and they put quite a lot of economic stimulus to support the global economy. But in the moment of stimulating, one of the things we don't think of is, hey, wait a minute, are there consequences that will impact markets over the long term? So if we continue along this path, If we go back to 2008 global financial crisis, Henk Paulson, Treasury Secretary at the USA, you can see this particular article that I've got up on the screen, September 30, 2008. Henk Paulson went down on bended knee on House Speaker Nancy Pelosi, begging for a $700 billion bailout for the US banks. And there was a lot of fighting. If you go back to history and you study this particular period in time, around September in 2008, when the banks were collapsing, actually there was a lot of fighting, but actually Henk Paulson and all his cohorts had to go and beg for $700 billion US. Now, let's forget that. Because back at that time also, the idea of debt was something that people were very prudent and cautious about, even if it was for a good thing. Now, if we look forward and we say, wait, so COVID hit in 2020, the level of global stimulus that has been put into the system, the medicine, as we would call it, that's gone in to rescue the global economy and global markets, far surpasses what went on in 2008. I mean, if we really look at this, then in 2020, if you look at this particular charts, it says general government deficits as a percentage of GDP. And you can see it starts off in 2008. You can see 2009 for the USA, huge stimulus. But if you look at, by the time you're getting to 2020 and 2021, this dwarfs anything for every government. So therefore, what has happened in 2021, what used to take Treasury secretaries begging on their knees to get done in 2008, now is much quicker. So what happened in 2020? Well, in the US, they passed the $2.32 trillion CARES Act in March, exceptionally quickly. There was no begging. The House came together, and you know the US is very bipartisan, very strange and tense environment around government and getting things done. But in March, while economies were getting locked down, they passed a 2.2 trillion rand CARES Act. In December of 2020, they followed that up with another 900 billion stimulus. And then Joe Biden elected, and earlier this year, Joe Biden passed a 1.9 trillion rand stimulus. So you can see 2008, 700 billion was a big ask. All of a sudden, we're passing trillions, and they all follow each other, and that's far less of. So now our statement over here, actually the following statement, I think, kind of sums this up. That if there's one common theme in a vast range of crises, because we had a crisis last year, is that excessive debt accumulation, whether it is by the government, banks, corporations, or consumers, often poses greater systemic risks than it seems during the boom. So at the moment, markets are healthy, markets are brilliant, markets are booming, they've recovered, and they've recovered spectacularly. And if you took advantage, like Graham was saying, of buying at the bottom and utilizing, actually you've generated some amazing returns. But all of the stimulus that has supported the market is actually, it's government debt. Now, we know that this government debt in South Africa is quite high, but actually if you look at globally, there's a lot of government debt, and actually it is all just increased materially given the stimulus that has come in. So what are we saying? We're saying, hey, at this moment, when we sit here today, we're looking at this and we're saying, oh, this is good, it's good for the market, it's supportive for the markets. But there's a warning here, because just like this particular quote talks about, it often poses greater systemic risk than it seems during the boom. There will be consequences to all this debt and the speed of how this debt has come into the system. And this is possibly the biggest risk that is facing global markets going forward that we're going to have to apply our mind to. I mean, there are lots of articles like this. If you just go and Google inflation, you will find a staggering and an increasing amount of publications. I mean, here, China issues an inflation warning on rising commodity consumer prices threaten an economic recovery. And so here, we've got one of the biggest threats to wealth creation, inflation. Inflation has been gone for a material amount of time. Now, if you're sitting in South Africa and you look at the South African, just think about the petrol price increases that you've had over the last 2 months. Those have been material. Where do those feed into? They'll feed into the actual underlying economy. They'll feed into our consumption. They'll feed into the food prices, the cost of travel. But yeah, there's a warning. There's been a lot of stimulus. Commodity prices have risen, and actually consumer prices are starting to threaten the global economy. So therefore, we're saying, hey, wait a minute. there's a threat here. There's a risk here in the markets. We need to pay attention to it. In our publication, actually, we've got 8 lessons, long-term perspectives. 8 lessons, we want to do some wealth creation. And lesson number 1, inflation is the enemy. Why? Because inflation actually is the reason why you've got to invest, because inflation over time will erode your spending power. So as I say here, and which is in the publication, reality is that many investors suffer from inflation illusion. They don't notice how destructive inflation can be over time. And the lesson is we need to look at long-term investment returns in real terms, which means after inflation and stripping out inflation. And here you can always see it. So if you take inflation at 6% inflation rate, effectively, what does it do to your money? So today, if you've got 10,000 Rand and inflation is at 6%, and you leave your money under the mattress, as people say, actually in 10 years, your money its purchasing power will be 5,584. 20 years later, your money's purchasing power will be 3,118. Inflation is very dangerous in terms of wealth creation, and we can see its impact. It's why I think parents, especially as we get older, we start telling our kids, well, when I was young, I used to buy chappies for 10 cents or 20 cents, depending on whenever that was. What has happened to prices? All of that is inflation. So unless your wealth is invested in real assets that can grow above inflation, actually your spending power is going to decline. And I love this quote by Ronald Reagan. Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman, except comes to you in a very unassuming fashion. Now, one of the things then, and actually talking about inflation, if we look at global economics forecasts, economists are starting to revise inflation expectations up. Now, initially, we started to see them globally. They would do 2021. So we started seeing 2021. If you look at forecasts relative to where we were in 2020, they were starting to add quite a bit of inflation forecast. And now, all of a sudden, in 2022, we're starting to see higher and higher inflation expectations. Now, where's the danger here? The second danger of inflation is that global markets at the moment are supported, and global markets are healthy, and actually you've made some fantastic returns in the markets, but they're supported by one underlying assumption, that interest rates stay longer for lower, that the stimulus that has been put into the market in terms of lower rates, and you can see over here from 2029, rates basically fell to the floor and have stayed there, and in the developed world, rates are negative. And so therefore, you have to pay to put your money in the bank. And so if inflation rises, there's a risk here that interest rates, which is the natural curve of inflation, have to follow suit. Now, if that happens, there's going to be consequences in terms of what happens to global markets, because global markets price the future, and you discount future profits at an appropriate rate. Now, at the moment, in the developed world especially, that rate is basically close to zero. But if that rate changes, that means your future profits are going to be brought back to today at a much higher rate, which means you will be less, which means market have to adjust downwards. So what are the risks that are out there in terms of inflation? Well, it's about rates. And so therefore, we've got to start thinking about how do we build portfolios that if we recognize that this is a risk in the markets, how do our portfolios handle it? So this is something that we're probably going to be talking about even in next year's publication as the data starts coming in. But we think if we take a long-term perspective, this is one of the key things that we're going to start discussing globally, inflation and the risk therein. But what's the impact of COVID? Because COVID has changed businesses and has changed. And I'm going to touch on just 3 industries, and I'm going to do that very quickly. Then I'm going to pass on back to Graham, who's going to sum it up for us. So businesses evolve. This is why in our teams, we hire a large team of investment analysts who scrutinize each and every business, because businesses evolve, they change. And COVID-19 brought on the spur of some interesting changes in terms of businesses. One of the first ones we want to talk about, this is a slide from Nedbank and in terms of their annual reports, annual results that came out up to December 2013. Now, this is their digital uptake. So banks have been trying to convince consumers to bank using their phones and their apps, so bank digitally. Because if you think about it, banks have to support cash. Cash is very expensive in South Africa because you've got to secure the branch, you've got to secure the cash, you've got to secure the vehicles that carry cash. And so therefore, if you get people to actually start banking on their phones, you don't need that many branches anymore. You don't need that much security anymore. So therefore, the cost of doing business is lower, which means banks then can become more profitable, or they will pass those profits back to the consumer, which means the cost of doing business with the bank and the consumer will become lower. Now, COVID came, banks have been trying to convince everybody to move into a digital landscape. Now you couldn't go to the branch. And all of a sudden, the digital adoption you can see in terms of the third tab here, app transaction volumes up 70% from 2019. People are digitizing, and there's been massive digital adoption, and this is changing how banks operate. It's easy to see winners in terms of tech companies, because we say, oh, that's a tech company, it won during COVID. But actually, every company has to focus on their technology aspect, and as time goes by, we're going to start seeing companies like banks changing their own offerings to deal with a more digital world. And that's going to change how they earn profits, where they earn. It's going to change their cost bases. But COVID is changing this. And our job is to analyze and say, hey, is there an investment opportunity here that nobody else is spotting? The second one is clothing retail. And again, retail, especially in South Africa, everyone said, no, in South Africa, we don't have enough internet penetration. No one is interested in shopping online. But this is Foschini, very successful retailer. And again, this is on their recent results. If you look at the yellow bit about the e-commerce surge, so number 3 over there, so 152% growth. Now, it's off a very low base, but 152% growth between May and September 2020 in terms of e-commerce purchases. People have had to learn new habits. And again, here, all of a sudden, 14% of group turnover contribution comes from e-commerce. It used to be 8%. Again, material growth. And so what does this mean for Foschini? Well, at the blurb at the top here tells you what the business is doing. Superbitus founders have joined TFG to help the company create a world-class omni-channel shopping experience. Okay, so Foschini is looking forward and saying, wait, how we sell clothes today is not how we're going to sell clothes tomorrow. We actually need to be online. Again, that changes their cost structure. Do they need that many shops? In fact, do the shops need to look as big as they look? Or are the shops just going to be something that we've seen in other geographies like Australia, where someone comes in, they try things on, actually they'll deliver it to your house at the right size, which means it costs less to operate a retailer. And so therefore, e-commerce is changing businesses. Again, that's why we have a bunch of analysts who look at companies and say, wait, how will clothing retail look like 5 years, 10 years from now? But I've shown you 2 industries which we think they're going to be positive economic impacts because of COVID. But one industry that is going to be challenged is property. Like I've said, if we look at banks are saying, well, we need less branches, we need smaller branches, the branches don't need to carry cash. Okay, where are those branches? They're branches, banks lease their branches of some property company. And so therefore, if they are saying we want less space, who's going to take the space? If the clothing guys are saying, hey, I've got another channel, I can sell my clothes online, and maybe I also need less space. Again, what does that mean for property companies? And here you can see the long-term trends in terms of since the early 90s of vacancies. That vacancies were fairly high, but all of a sudden, as COVID has taken off, vacancies are actually increasing at a very rapid rate. Now, not only are vacancies increasing at a rapid rate, rentals are dropping. I mean, when we speak to the retailers, because again, with our team of analysts, the retailers are telling us, oh, well, each time we come to the landlord and we say we want better rentals, we're getting them. Because, well, property companies are struggling. The other side of the property companies is that people like me, we're doing this presentation, I'm sitting at home, and so are my other colleagues. And so therefore, the idea of working from home, what happens to office space? Large blocks of office space, and yet probably we will use it in some combined fashion. But the pricing power of the property landlord is probably permanently diminished in some way. And so therefore, property as a sector is challenged. And so therefore, we've then got to ask harder questions about how does this fix itself? How does it solve itself? And so those are the 3 sectors that we have looked at and said, hey, these have changed because of COVID. So in conclusion, basically, I think there are a few things. One, the three things I want to leave you with. Local investors have had a challenging few years. 2020 tested our resolve even further, but the application of lessons learned, again, go back to the publication, has proved invaluable. Go back to those lessons, long-term perspective to create long-term wealth. Looking forward, cash is unattractive. The value is in growth and duration assets, especially when the first enemy is inflation. And I think we've given you a hint that actually, hey, wait a minute, inflation might have been gone, but hey, there's a threat here, and you need to make sure you're on the right risk assets that can weather inflation and give you growth above and allow you to create long-term capital returns. And then looking forward, we look forward about the COVID impact. I've just spoken about the digital footprint. And also the fact that business models need to be revised, which will change the profit structures of companies and change what businesses are worth, especially for those who adapt early and those who are adopt in the front end of the curve. And our job is to find those companies, identify them, and make sure that we've positioned our clients in them. And so we will now switch over to the Q&A.
Says, and it's for yourself, so it says, can the world afford interest rates to increase with the massive increase in global government and corporate debt? Yes, inflation is a concern where there may be some base effects due to global lockdown on average from March to June 2020. Your thoughts, please.
Thank you for that question. It's and I like that question, is that whether the world can afford it. And I actually think that's not the point, because the world does not have a choice. Because obviously we lock down supply chains, commodity prices are rising, soft commodity and hard commodity and prices are rising. And so therefore we are seeing increasing and ever increasing inflationary effects. Now, historically, to combat inflation and its danger in eroding purchasing power, governments have had to increase interest rates. And so therefore, at the moment now, governments are stuck in the sense that they've got these massive debt burdens at very low rates. Companies are also in the same position of massive debt burdens at very low rates. And so therefore, actually, the global markets can't afford to raise rates. But what choice will they have if inflation gets out of hand? That's why the Fed, Jerome Powell, came out and said, well, we will target up to 2%. Now, that is very interesting. They're flagging that actually we're going to get to it. There's a certain level that we are comfortable with. But if you go back and study inflation, inflation is proved to be unwieldy when it gets going. It's difficult to start. It's difficult to contain. And so therefore, for us, that's why we're saying, yes, maybe the world can't afford it. But actually, once it gets going, you have no choice but to respond to it. And so we are flagging and we're saying, hey, there's a risk here. You've got to be careful. We've got to make sure we're building our portfolios in cognizant that this risk exists, because the markets, the biggest danger in markets are the assumptions that things aren't going to happen. So at the moment, the global markets are pricing in that rates are going to be lower for longer. Now, if they're right, that's okay. Prices can stay where they are. The risks are over, is that there's a response. Just like we've seen in Brazil. Brazil raised rates recently, and suddenly there was a wobble in the markets. So if that happens, then the assumptions that support equity valuations are under pressure. And we need to build portfolios that can handle those scenarios too, whether or not we believe they can happen.
Thanks, Sibo. The next question I've got is...
Gontse, can you hear me now?
Graham?
Sorry,
Yes.
I had a connectivity issue, so I'm back on. Is this the question around inflation and hiking interest rates?
Yes.
Yeah, Sibo's
so I
just...
think, sorry, I don't know if Sibo
mentioned...
Yeah, sorry, I don't know if Sibo mentioned this. The one thing that the Federal Reserve has come out to say is that inflation isn't a one-year event, it's a multi-year phenomenon. And they've tolerated, or they've had inflation well below their 2% target for a number of years now. Hence, they are more comfortable having inflation run above that, because over the long term, they're getting to that average of 2. So I think they've indicated that there is space to allow inflation to rise. I suppose what we're trying to flag as a risk is that inflation actually gets out of control. So it's not that it recovers off a low base and it spikes for one year. It's actually that it becomes a far more persistent issue and gets well above that 2% target, possibly 4% or 5% in the US, for example. But I think the other reason why we're bringing back the reminder about inflation as a key lesson is because we've been living in a very disinflationary world. Inflation has been very low for the last few years, and the risk is that we become complacent around that, particularly as South African investors. And we have to remember that as South African investors, our inflation rate is driven by three key factors. One of them is the currency, although that's been somewhat more muted of late. Number two is food prices, and number three is oil prices. And so we need to keep a careful eye on what's happening there and how that's going to feed through into our inflation down the line. We're still unofficially targeting 4.5% inflation in South Africa, and we're currently well below that.
Cool.
Thanks.
Thanks for that, Graham. The next one's actually going to start off with you, and we've got the 8 lessons, and they're applicable over the entire period of time that we've done this research. But over the past 8 years, and particularly looking at now with the COVID crash that we've had, but also probably around 2007, 2008 when we had the global financial crisis, do any of the lessons either show up more prominently or less prominently in these types of market conditions? And if so, which ones? Maybe you can just talk us through a couple of those.
Right. So I think they fire at different times. So as Simon mentioned, the expectation for interest rates is to remain at these low levels for quite some time. If I remember correctly, the South African Reserve Bank is expecting 2 small interest rate hikes later this year. We'll have to see if that plays out. But across the world, many countries, many central banks are going to keep their interest rates at quite low levels for now, based on what they're seeing. So that for me reinforces the theme around cash, or the lesson around cash, that it's going to be a very expensive asset to hold for the foreseeable future, and also reinforces the story around the need for growth assets. So if you want to grow your real wealth, we're seeing a lot of opportunities in equity markets. So it may not be going and buying the broad equity market, but definitely there's selection. There's selection alpha is how we would refer to it on the table. And so you need active asset allocation to be able to do that. So as an example, last year we bought value in the portfolio, and within the global portion of our equity, we rotated from growth, which is mostly tech, into value, which is more your financials. Having that asset allocation ability was key. I think those for me would probably be the 2 main lessons that we still need to take out and apply going forward at this point. I think those are the 2 keys.
Nothing to add from your side, Sibo?
No, nothing to add. I think Graham has adequately covered it.
All good. Then the next one will also be for you, Graham, and Sibu, you can also come in, but it basically speaks to the local versus offshore exposure that we find in the funds, and where you sit in terms of how you use that. And I think the backdrop for this is that leading up into the COVID-19 crash, you had global equities outperforming local equities. And then now you've had this strong rebound locally. So local equities are doing very well. There's questions around how sustainable that is. But if you're a client, you're sitting there now, you may have been positioned either quite strongly from an offshore global perspective in the run up to this. Do you now come back into local in terms of your portfolio? And particularly when you look at people's discretionary portfolios, where should those be tilting towards? And is that the same to how you're tilting the portfolios you imagine? And I think, Graham, it's a question suited to you because you've got so much room in terms of how much global exposure you can pull into the balance fund.
Right. So it's quite an interesting one because I mentioned in the beginning of the presentation, we were talking about the fall in markets, but we also saw the Rand spike up quite sharply. So the Rand moved from 14 at the beginning of 2020 out to, I think it got to very close or just beyond 19 to the dollar within 3 months. And historically, when we've seen that, it's led to people wanting to take money out of the country at those levels because the currency is obviously going to 40 or 50 or whatever the number is. When again, you wanted to do the exact opposite, you almost wanted to bring money back. So the approach that we've taken over the last year looking at this is we actually believe that South Africa is very well positioned to outperform going forward. A lot of that is driven on the back of valuation. So if you look at the valuation of, say, the US equity market, it is very expensive in our view, whereas the South African equity market, there are some very attractively priced sectors or industries out there. And so we've been rotating more and more into South African equity. As an example, in the balanced fund, we took the SA equity exposure from about 35% of the portfolio up to about 47% of the portfolio. So when we were buying equity last year on behalf of clients, the bulk of that was in South African equity. We weren't chasing the global markets. We were looking for where do we see the best bang for buck, and that, in our view, was the South African equity market. And so part of that is on the back of valuations, but it's also as the global economy recovers and as we see the reopening with vaccination rollouts and so on, South Africa is a global play. It always has been. It will probably be for quite some time to come. And so as the global economy recovers, that should flow through into the South African economy, and that will help unlock some of those very attractive valuations that we're seeing in stocks. So what we've been doing in the portfolios is moving more money into South African assets and away from global assets. In terms of what people should be doing with their discretionary money, I don't think that's something I can answer. I can only tell you what we're doing in funds. But I mean, if I look at what Peter Brook has been doing with maximum return, it's along the same lines. It's about buying South African assets that are very attractively valued. So the small cap area in particular is something that we've invested quite heavily in. Because again, a lot of those companies they took a real beating in the crisis, and so there's a lot of value there. Because if you've managed to survive the crisis, if you've managed to get your head through the other side of this, you are very well positioned to outperform going forward. Because a lot of your competitors have unfortunately closed shop. So I think there's been a fair bit of consolidation in various industries as well, and that benefits the survivors down the line.
Thanks.
Can I add a quick one to that one, Gontse? I mean, I think
sure, go
in summation, when you are buying or when you are investing in a company, in terms of equities, what are you buying? You're buying a future stream of earnings or cash flow into the future. Now, then you've got to understand and you pay a certain price for those earnings. That's why we use a PE ratio. You price for the earnings that you're buying. And so in the US, if you take the US, so if you're going offshore, one of the things to think about is the level of those earnings. So where are those earnings relative to history? Now, in the US, tax rates, thanks to Donald Trump, are extremely low. Okay, there's talk now of increasing tax rates to pay for all of the stimulus, but tax rates are low. Interest rates are very low. And actually, the economy has been exceptionally healthy, barring COVID. And so therefore, the earnings level in the US is very, very high. And on top of the earnings levels being high, you're also paying a very high multiple. So now you're paying big earnings and big multiple. Now remember, what are the risks then? Well, the risks are if rates increase, that takes away some of those earnings. If taxes increase, that takes away some of that. If the economy wobbles a little bit, that takes away that purchasing power. And so these earnings are at risk, but the price is high. So the price isn't fully discounting the risks that are in the earnings. If you're going offshore, remember that the MSCI All Country World Index is 58% US. So if you go offshore just on a traditional equity index, you're actually buying 60% basically of the US. Come to South Africa, apply the same matrix. There's been no growth in South Africa. So the earnings levels actually are relatively low. Companies in South Africa over the last 5 years have had to fight to survive. They've cut a lot of costs. They've had to reshape their business models. They've had to really focus on the nuances in order to survive. Now, South Africa, also then on the price side of it, has been a loathed investment destination. No one has liked South Africa. Everybody hates it. Everybody thinks this is terrible. The country is a disaster. It's not, nothing good is going to come out of it. The price you're paying in South Africa is low. The earnings are low. Now, over the last year, since if you take on after COVID, so April to March that we've just had, South Africa, the South African index, cap SWIX, did 54%. Now, the global index, if you're a South African investor, did actually, because of the rand strengthening, as Graham said, that did 28%. And if you look at the actual reporting of South African companies, statistically, South African companies all generally surprise positively in terms of their earnings expectations. Why? Because, well, the earnings are low. When your earnings are low, for you to surprise positively is easy. And actually, we've had quite a lot of companies in South Africa that have doubled in share price, like Foschini, Soho-san, Super Group. Like, these are domestically focused shares. They've doubled over the last year. Very little has happened. Why? The earnings were low, but the price you were paying for them was low. So that's why we're seeing great opportunity in South Africa. And yes, we think the country is challenged, but actually the one thing we forget about the country being challenged is that in a global world that is growing, commodity prices are high. South Africa is a commodity producing nation. And so therefore, that's why everyone said the budget was good in February. It's a good budget. Why? Because actually our revenue exceeded expectations and even the government's expectations. Because why? Because the mining companies are making super profits and are paying more taxes and are now thinking about investing in South Africa. That's how you get a positive surprise. And I think that's not baked into the South African valuation prices. That's why we see opportunities in South Africa.
Thanks. And just to be clear, when Siboniso is talking about South Africa and I'm talking about South African equity, we're talking about those companies that are SA facing.
Yeah.
It's not that there's obviously a large global component to our markets. It's not those guys. It's the SA Inc. portion of the market that we find very attractive.
Cool. Next one says, and Sibu, maybe you can have a look at it first. If the markets carry systemic risk due to inflation risk, are alternative assets not a natural hedge for inflation? How's your portfolio planning on accommodating the Regulation 28 changes?
Yeah, I mean, if you look at the history of inflation and which assets perform well under inflationary circumstances around the world, which is work that obviously we spend quite a bit of time doing, real assets, actually, which is real estate, alternative assets, etc. So, and value instead of growth, as Graham intimated. And so, yes, that is true. The only trick with accessing alternative assets is actually quite difficult, especially for the normal retail investor. Now, in our solutions, we do have a space where we access alternative assets, and fortunately at Old Mutual, we've got some fantastic alternative assets capabilities. So the answer is yes, they are a natural hedge and fantastic hedge, just like all real assets are. Now, on the other side of it, though, is that we've got to consider, can you access them, and then how much time? Because the things about alternative assets is that actually you need to be in and you need to stay there, and there's a liquidity that you give up for quite a few years for that to mature. But again, if you take a long-term perspective, I think it'll work out well for you. So the answer is yes, but actually you've then got to plan your investment horizon well. And I think Graham can then talk to us about how we've positioned in alternatives in the portfolios.
Yeah, so just on what Siboniso was saying, you've obviously got to consider the liquidity risk. And unfortunately for retail assets, we don't have the ability to go into alternative assets. It's a pricing issue. It's a regulatory constraint that we have. In terms of funds that we manage that only need to be Regulation 28 compliant and not CISCA compliant. In several of those funds, we have introduced alternative assets into the portfolio over the years. It's a lot of it tends to be quite, if you use the word lumpy, because it depends on the opportunities and when they come up. But we have allocated into that space, and it's something that we're continuously looking at because, as I said, we don't want to have cash in the portfolio, so we're looking for ways to allocate that cash out. And I think those are potentially very attractive, especially now, given some of the pricing and how those prices would have been affected during the COVID crisis. But it's very specific portfolios that have those alternative assets in them.
Great, thanks for that. And another one which says global central bank stimulus has created the extreme levels of markets. An example of this is low interest rates. How do retirees navigate the near future whilst drawing down, as your principles account for growth build-up, not deaccumulation or equity sequence risk? And in brackets, the person says this would be vital to a retiree.
Do you want to give us a go, Siboniso?
Yeah, so this is actually a pivotal question in a low return world, which I think historically we used to speak a lot more about. In that if you've got a retiree, rates are exceptionally low, you've got a risk cognizant portfolio, because if you're retired, you don't have 80% of your portfolio in growth assets such as equities, because of the risk of how you structure portfolios in that time of your life. So this is actually just difficult. And so therefore, we provide solutions which are like real income or one of our stable funds, which have some growth assets, but actually have quite a bit of other multi-assets. And so it depends on the product that you are in. And so therefore, I think this is our job to try and find where can we access real returns for actually commensurate risk. But I do think that the world we're in at the moment actually penalizes savers in order to actually keep the world economy and markets afloat. And you can't have one without the other. So I don't know, Graham, whether you can give a better answer there, but it's a very, very difficult question that will probably be difficult for years to come.
Yeah, and it's been a difficult question now as well, because a lot of the questions that we've had in recent years have been about people who have entered retirement, but they're about to enter retirement and they haven't had the returns from equity markets. Now it's shifted, and it's now about those who are retired and are dependent upon that yield from cash. So that I don't think that cash yield is going to be there anytime soon again. Our real yields in South Africa were very high. There were strong arguments to be made for reducing those real yields. But I think Siboniso mentioned real income and stable growth as two of our more conservative offerings. I mean, even though the cash yields are low, the yields on our bonds are still very high. They're pricing in a lot of negativity. And I mean, if we look at the budget now in February, that surprised on the upside. If we look at recent revenue collections, again, it's surprised on the upside. The situation is still dire, but we're moving in the right direction. And I think if we continue on that path, the bonds offer a phenomenal value given their current yields. So a lot of risk already priced in. And if things start to turn, you could get really good returns from those bonds. But this whole thing is quite a challenge. Yeah.
No, I like that response. Apart from the risk being removed, there's still some considerable upside that is not so risky per se in those types of solutions. So a good option. Unfortunately, that's all we have time for today. Thank you for joining us. From Graham, from Sibo, myself, and the rest of the team. Have a great week further, and goodbye.